Imagine this for a moment. At the same instant, the very same asset is trading at two different prices in two different places. On one platform, it is listed at $100. On another, it is priced at $105. Nothing about the asset has changed, only where it is being traded. In theory, you could buy at the lower price and sell at the higher one almost immediately. No forecasting, no waiting for a bull market, just exploiting a price difference that already exists. This concept is known as arbitrage. In this video, I will explain what arbitrage actually is, why these price gaps appear even in highly competitive markets, and, most importantly, why the straightforward opportunities most people imagine are largely inaccessible to individual traders today. Welcome to Marcus, where complex investing ideas are broken down clearly and practically. Before we continue, a brief disclaimer. This content is for educational purposes only and does not constitute financial advice. Let's start with a simple example. Suppose a trading system purchases an asset on exchange A for $100 and simultaneously sells it on exchange B for $105. Ignoring fees and assuming perfect execution, that trader earns $5 per unit. This is why arbitrage is often described as risk-free profit. However, that description is theoretical. We will revisit the real-world risks shortly. This basic setup is known as spatial arbitrage, the same asset traded in different locations or on different exchanges at different prices. It is the most intuitive form of arbitrage. But it raises an obvious question. If markets are supposed to be efficient, why do these discrepancies exist at all? There are several reasons. First, exchanges are not perfectly synchronized. Whether we're talking about cryptocurrencies, equities, or commodities, different venues process information and orders at slightly different speeds. Second, geography matters. Local regulations, tax structures, capital controls, and regional supply and demand imbalances can all influence pricing. Third, there are time and information delays. News does not reach every participant simultaneously. Large institutions often receive data feeds faster than retail traders, allowing them to react before prices fully adjust. These small inefficiencies can create brief windows, sometimes lasting seconds, sometimes only milliseconds, where prices temporarily diverge. Spatial arbitrage is just one category. Another common form is triangular arbitrage, most often seen in foreign exchange markets. Here, a trader cycles through three currencies, such as dollars to euros, euros to yen, and yen back to dollars. Due to minor inconsistencies in exchange rates, the final amount can exceed the starting amount. A third type is risk arbitrage, also known as merger arbitrage. When a company announces it will be acquired, its stock typically trades slightly below the agreed purchase price. Traders buy the stock, expecting the deal to close and the price to converge. The risk, of course, is that the transaction fails, sending the stock sharply lower. This brings us back to the idea of risk-free arbitrage. In practice, arbitrage is lower risk than many trading strategies, but it is never completely riskless. Several things can go wrong. Execution risk is a major factor. By the time a buy order is filled on one exchange, the sell price on the other may have already moved. Transaction costs also matter. Even small fees can eliminate thin profit margins. Liquidity is another constraint. The attractive price may only be available for a small quantity. And in markets like crypto, transfer and withdrawal delays can completely erase an opportunity before assets arrive. So while arbitrage does not depend on predicting market direction, it still involves real operational and market risks. Today, most arbitrage profits are captured by professional firms. These include high-frequency trading companies, hedge funds, proprietary trading desks, and large crypto market makers. They operate with advantages that are simply not available to most individuals. Their servers are physically located next to exchange infrastructure, reducing latency to microseconds. They receive direct data feeds rather than delayed public prices. They pay extremely low trading fees. They deploy significant capital without moving the market. And they use automated systems to scan thousands of markets continuously. As a result, when a price gap appears, it is usually corrected almost instantly. Arbitrage traders buy where the asset is cheap, pushing that price up, and sell where the asset is expensive, pushing that price down. The act of arbitraging forces prices back into alignment. In modern, liquid markets, this process often completes in fractions of a second. There is an irony here. Arbitrageurs, often criticized for exploiting inefficiencies, are actually a key reason markets function as well as they do. Their activity keeps prices aligned across venues, improves liquidity, and helps ensure that prices reflect real supply and demand. If you found this breakdown useful and want more clear explanations of investing concepts, consider liking the video and subscribing to the channel. It helps support the work and grow the community. Thanks for watching, and I will see you in the next video.